You are average. Your investments are average, but yet they are never average. What do I mean? So for today, I'm going to talk about a really fascinating phenomenon when it comes to investing and how sort of to think through it. So picture this: the S&P 500 over the last 63 years total returns on an annualized basis is about 8% a year return. Pretty good. In real figures, that means your money should double every approximately 9 years. So $100,000 at 200, 400, 800, do the math. Pretty simple. Yet, the confusing thing is this. Guess how many times over the past 63 years the S&P 500 has performed 8% in a given year? Goose egg, zero. Think about that. So not one says the S&P 500. You open up your statement at the end of the year and just said, it's done 8%. Of course, that's why you diversify. But it's a really fascinating sort of social experiment, and why we have a job and why it's so critical, I believe, is that the S&P 500 when markets, although they average something specific, they never hit that something specific. Now, granted, there's been 2 years within that 63. One was, I think, 7.6%, and there was another 6.5%. So it was pretty close to 8% on an annualized basis. However, those are the only 2 years out of 63 the S&P 500 has done between 6 and 10% in a given year. Now, that's where the nuance lies. So think about that. You're investing, and you want to just do average, because it's, or even slightly above average or slightly below. Who cares? If you're in that range, you can have a predictable plan. We have 63 years of data that suggests how the market should perform. But the devil lies in the details, which is that too many people overreact or let their emotions and biases get in the way. So, if going into it, I tell you, invest with us, you'll do somewhere in that range over the long term. Then year one, if you do 20%, don't expect that to continue. And year two, if you do minus 20%, don't expect that to continue. The issue lies when you start overreacting or underreacting or making sharp changes and not letting the investments work. Now, of course, here at Diversify, we take tactical shifts and overweight certain areas, but that's not based on knee-jerk reactions. It's based on data and things of that nature, and analysts, and a pretty impressive investment team here that's handling over $1 billion. So it's something that we put a lot of resources in. And being average allows you to build financial plans, allows us to build financial plans and predict how and what we need to put away and where we need to get to. And if we try to deviate too much from that course, it can not only result in bad investment performance, or not average, let's call it, investment performance, but it can lead to an unpredictable financial future. And that's the thing we have to avoid. When you think about it, being average in investing is exactly what we should be striving for. We can protect it with diversification, which we're keen on, and we can take tactical shifts and certain bets to over and underweight areas that are soft or weak or undervalued, and then allow investments to work and planning to work. So remember, when it comes to investing, average is okay, but don't ever expect average. It's very confusing, I know. It's a fascinating statistic, if you ask me. It's why I focused today's blog on it. And know that we are here to help you as always, and guide you as always, and give you our best. So, as always, I'm Andrew Rosen, President of Diversified. Stay wealthy, stay healthy, and stay happy. Bye.